Welcome to Chapter 13, Part 1, the Statement of Cash Flows. And as always, use the table of contents to switch between slides. We have a lot of learning objectives this chapter, and I want to draw your attention to a couple that we're not including. So obviously, the ones up here, we are including Statement of Cash Flow, primary purpose, its usefulness, and that's kind of more of the theory area. Understand the three major sections of the statement of cash flow: operating, investing, and financing, and also non-cash. Analyze a company's cash flow statement. Really look at it and say, what is this company doing? Is this company healthy? And the big piece of this chapter, you won't be doing any journal entries this chapter, but the big piece of this chapter is that you need to be able to prepare a complete statement of cash flows using the indirect method. You are not responsible to be able to prepare a cash flow using the direct method. Let me say that again. You're not responsible to create a statement of cash flows from scratch using the direct method. You are also not responsible to know the worksheet method for the cash flow, but you will be given a blank sheet of paper and be asked to prepare a complete cash flow statement using the indirect method. In addition to what's in your chapter, I am including supplementary material. This is not in your book. You're only going to see this on the PowerPoint slides, and it has to do with the product life cycle and the cash flow report. So why do we need a cash flow report? You've got the income statement, the statement of retained earnings, and the balance sheet. What does the cash flow give to us that those other statements do not? Well, it really just focuses on cash receipts, cash payments, and net change in cash in the three big areas: operations, investing, and financing. And kind of for a clue here, cash coming in I'm showing in green, cash receipts, cash payments, cash going out I'm showing in red. I apologize if you're colorblind. The words should be self-explanatory, but if you're not, that's just a helpful aid. So what do we mean by operations, investing, and financing? Operations. If you think of a store, you think of what it does on a day-to-day basis. It buys inventory, it stocks the shelves, and it sells inventory. Investing, on the other hand, would be the big purchase items, things you're buying not to resell, but things you're buying to help you run your business. So staying with my store example, you might buy the building, you might buy the furniture, the fixtures, the cash registers. Those would be investing decisions. Financing. That's how you paid for those investments, particularly for startup companies. So when you start a company, you either finance it with owner's investment, which is stock, or you finance it with a loan, which is your liability. So your investing is what you spend the money on, your assets, and your financing is your liabilities and your stockholders' equity. So what do we want to know when we look at the statement of cash flow? Where did the money come from? What did we use it for? And what was the change in the cash balance? In your personal lives, have you ever asked yourselves that question? Hey, I went to the ATM on Friday. I got out $60 or $80 or anything in a multiple of 20. Monday morning, I had $5. What in the world did I spend that money on? And so companies also look at their cash flow, their beginning balance, their ending balance, and they want to know what the money was used for. Investors want to know this too, and so do short-term creditors. How is the company managing its cash? So let's dissect those three terms in a little more detail. Operating activities involve income statement items. They're the cash that results from revenue coming in and expenses going out. It's whatever it takes to determine net income. Those are operating activities for the purposes of the cash flow report. Let's take some examples. Some of these things make sense right off the top. A company sells goods or services. That's an operating activity. A company is paid cash on account. That's an operating activity. I'm going to skip this one for a minute. Cash outflows. A company pays its own suppliers for inventory. So if Costco buys 100 Vizio big screen televisions, they pay Vizio for those televisions. A company pays down accounts payable. A company buys something on credit and then it pays it down. A company pays its employees, the government, short-term lenders, or anybody else for expenses, utility expenses, rent expenses, supplies expenses. Now this second one up here, from interest, cash inflow, interest received, and dividends received. That is also considered an operating activity. Interest received, as we learned in Chapter 12, is interest income or interest revenue. Dividends received are also revenue, dividend revenue, and they are considered operating activities, and this is really an exception. They are considered operating activities because those two items show up on the income statement. So again, the rule is if it's on the income statement, in general, the rule is if it's on the income statement, it's an operating activity. Okay, operating activity alert. Some cash flows related to investing or financing are classified as operating activities. For example, just as I said, receipt of investment revenue, interest revenue, dividend revenue, payments of interest to lenders, that would be interest expense. Why are both of those two items included? This is an exception, but it's because they're included on the income statement. And finally, the last exception, sale or purchase of trading securities, short-term securities. Trading securities are categorized as current assets, and changes in current assets are included in the cash flow statement. And this will make more sense to you when we actually work through the cash flow report, but I wanted to alert you to this right now. Investing activities. Purchasing and disposing. Now, this is more obvious. Okay, investing activities are when a company buys fixed assets, and for the most part, they're buying it. So I'm showing this as cash out. And at the end of its life, they might sell it for a small profit or a small gain. Those activities are always under investing. So they buy a piece of equipment, a forklift. 10 years later, it still has it's still useful, but they decide to get a newer forklift. If they sell that forklift, the cash that comes in from that sale. So the purchase would be the cash that went out to buy the forklift, and then the disposal that we'd recognize would be only the cash piece that's coming in. And for investing, if a company buys a debt investment in another company, in other words, for example, a company like Amazon, if they bought a GE bond, that would be considered an investment. So that would be money going out. They're loaning money to GE, and then when the money comes back, when it's due, they would collect it. So investing activities, if you consider your balance sheet, they're investments and long-term asset items on the balance sheet. So specific examples, cash inflows, sale of property, plant, and equipment. Now remember, we don't normally sell property, plant, and equipment except perhaps at the end of its useful life. So it would just be the cash that came in. Sale of debt or equity securities, collection of loans, cash outflow when you buy property, plant, and equipment. And this is really the most common one we see on the cash flow report. But a company could also loan money to other companies, or they could purchase debt or equity securities of any other entity or mutual fund, anything like that would be an investment. And why is that an investment? Because they have extra cash, they're buying a bond with the idea of making interest off of the bond and eventually collecting the principal back.